In October 1907, the American financial system began to break. Banks stopped paying out deposits. Crowds formed outside trust companies across New York City. The New York Stock Exchange fell nearly 50% from its peak. The United States Treasury had no emergency mechanism. No central bank existed. No coordinated rescue apparatus of any kind. But there was one man who was not surprised. He had been watching the weakness build for months. He knew which institutions were vulnerable. He knew what would happen when the first one fell. And when it fell, exactly as the timeline now shows he anticipated, he was the only private citizen in America with a rescue plan already prepared, a list of which banks would live, and a separate list of which banks would not. His name was J.P. Morgan. The standard account calls what happened next a rescue. Morgan stepped in where the government could not. He saved the American economy from collapse. He was 70 years old. He worked through the night. He was a patriot. That account is not wrong. It is incomplete. The documents now preserved at the Pierpont Morgan Library in New York, the presidential archives covering Morgan's private meetings with Theodore Roosevelt, and the congressional testimony Morgan gave under oath in December 1912 tell a more specific story. They document not just what Morgan did during the panic, they document what he did before it, what he knew, which banks he chose to save, which bank he chose to let die, and what he walked away with when it was over. This is that financial documented story. The American financial system in 1907 had a structural problem that anyone paying close attention could identify. Trust companies. A specific type of financial institution that operated like banks but without the regulatory requirements that applied to national banks, had been expanding rapidly for a decade. They held deposits. They made loans. They invested in speculative ventures. And they maintained far lower cash reserves than the regulated banks were required to hold. In 1907, trust companies in New York City held approximately 5% of their deposits in cash reserves. National banks under federal regulation held approximately 25%. The difference between 5% and 25% is the difference between a financial institution that can withstand a withdrawal surge and one that cannot. J.P. Morgan understood this arithmetic precisely. He had spent 40 years in American finance and had personally navigated the crisis of 1893 when the United States Treasury ran out of gold and Morgan himself organized a private syndicate to rescue the federal government. He was not a man who was surprised by financial crises. He was a man who saw them forming before they arrived. By 1907, Morgan's financial empire was without precedent in American history. He and his partners held controlling interests in 21 railroads. He had created U.S. Steel in 1901, the largest industrial transaction in American history to that point. He sat on the boards of Aetna, Western Union, the Pullman Car Company, General Electric, and International Harvester. The Pujo Committee would later document that institutions connected to Morgan held over $22 billion in assets. In 1907, the entire United States federal budget was approximately $1 billion per year. Morgan's network represented more than 20 times the annual expenditure of the federal government. A man with that level of financial intelligence and that depth of institutional knowledge did not arrive at the panic of October 1907 unprepared. The specific trigger for the 1907 crisis had roots that predated Otto Heinz's copper scheme by more than a year. In April 1906, the San Francisco earthquake caused catastrophic destruction and triggered massive insurance payments from British insurers. The Bank of England raised its discount rate to stem the flow of gold from Britain to the United States. This tightening of British credit reduced the global liquidity available to American financial markets. The American economy entered 1907 in a condition of credit contraction. Several Wall Street brokerages had already gone bankrupt. The stock market had been declining for months, and that structural vulnerability was precisely the environment in which a failed copper scheme could produce a systemic collapse rather than an isolated failure. The man who lit the fuse was Otto Heinze. Otto was the brother of F. Augustus Heinze, a copper mining magnate who had made his fortune in Montana and moved to New York to play the financial markets. In October 1907, Otto Heinze attempted to corner the market on United Copper Company shares. The plan was straightforward. Buy enough shares to control the supply, then force short sellers to buy from him at inflated prices. On Monday, the 14th of October, he began purchasing United Copper shares aggressively. The price rose from $39 to $52 in a single day. On Tuesday the 15th, he issued the call for short sellers to return the stock they had borrowed. The price rose to nearly $60. Then it collapsed. The short sellers found United Copper shares from sources Otto had not anticipated. He had misread the market completely. The share price of United Copper fell from $60 to $10 in 2 days. Otto Heinze was financially destroyed. The destruction spread immediately to his brother Augustus and to their banking associates. The Heinz name was now toxic in New York financial circles. Any institution associated with them faced a crisis of confidence. And one of those institutions was the Knickerbocker Trust Company, the third largest trust company in New York City, whose president, Charles T. Barney, was publicly known to be an associate of the Heinz circle. Subscribe now if this is the kind of documented financial history you have been looking for. This is only the beginning of what the documents show. Here is what the primary sources establish about the week before Knickerbocker collapsed. J.P. Morgan was in Richmond, Virginia, attending the Episcopal Convention when he received word about Knickerbocker's difficulties. He returned to New York a day ahead of schedule. He assembled a rescue team immediately. He sent his investigator, Benjamin Strong, a vice president at Bankers Trust, who would later become the first president of the Federal Reserve Bank of New York, to examine Knickerbocker's books. He was prepared before the crisis arrived. The question the documents raise is not whether he was competent. It is whether his competence included a specific decision about which institution would be allowed to fall first. On Friday the 18th of October 1907, news broke publicly that Knickerbocker Trust President Charles Barney was an associate of the disgraced Heinz circle. Depositors began withdrawing funds. The National Bank of Commerce, an institution in which J.P. Morgan was a dominant factor, had been quietly extending credit to Knickerbocker to hold off a depositor run. On Monday, the 21st of October, it stopped. The National Bank of Commerce announced it would no longer act as Knickerbocker's clearing agent. That announcement was understood across Wall Street as a verdict. If the institution that had been propping Knickerbocker up had withdrawn its support, Knickerbocker was finished. The Knickerbocker board dismissed Charles Barney the same day. The institution then sent a formal request for emergency assistance to J.P. Morgan. Morgan sent Benjamin Strong to examine the books and determine whether Knickerbocker was worth saving. Strong worked through the night. He could not make a definitive determination of the trust's solvency in the time available. Morgan used that uncertainty as his answer. He refused to save Knickerbocker Trust. On Tuesday, the 22nd of October 1907, the Knickerbocker Trust Company faced a classic bank run from the moment its doors opened. The New York Times reported that as fast as a depositor left the building, 10 more arrived asking for their money. Police were called to maintain order. 2 vanloads of banknotes were rushed to the tellers in an attempt to demonstrate solvency. It made no difference. Within 3 hours, Knickerbocker had paid out $8 million in cash and suspended operations. Its doors closed before noon. 48,000 depositors had accounts at Knickerbocker Trust. Most of them had done nothing wrong. They had placed their savings in what was widely considered a reputable institution. They lost access to their money the same morning they lost their trust in the institution that held it. They would not see that money again for 5 months. Knickerbocker Trust did not reopen until March 1908, after $2.4 million in new capital had been injected to restore its solvency. The depositors who had watched the doors close on the 22nd of October 1907 received access to their accounts in the spring of 1908. The institution that had failed them was technically restored. The 5 months in between, during which those 48,000 people could not access their own savings, is not a footnote in the standard account. It is the human cost of the decision Morgan made when Benjamin Strong's audit came back inconclusive. The suspension of Knickerbocker Trust sparked the full-scale financial crisis that followed. Within hours, depositors were running on every trust company in New York. The call money rate, the interest rate on overnight loans, jumped from 9.5% on the morning Knickerbocker closed to 70% the same afternoon. 2 days later, it reached 100%. At moments, there were no lending offers at any price. The human damage extended far beyond New York's trust companies. As the panic spread across the country, businesses could not obtain credit to meet payroll. Workers were laid off. Businesses that had nothing to do with trust companies or copper speculation found themselves unable to borrow at any interest rate. The Pittsburgh Stock Exchange suspended trading for 3 months. Banks in Providence, Philadelphia, and Pittsburgh sought emergency assistance. The Panic of 1907 produced one of the deepest recessions in American history between the Civil War and the Great Depression, a contraction felt by millions of ordinary Americans who had never heard of Otto Heinz, had never speculated in copper shares, and had no connection to the trust companies whose weakness had triggered the cascade. The panic that Morgan had watched building now arrived in full force. And Morgan, the man who had declined to save Knickerbocker, immediately announced he was ready to save everything else. There is a documented detail about what happened to Charles Barney 3 weeks after Knickerbocker closed that the standard account almost never includes. When Barney subsequently approached Morgan personally and asked for his help, Morgan refused to see him. Charles T.C. Barney shot himself on the 14th of November 1907. The president of the Knickerbocker Trust, the institution Morgan had declined to rescue, died by his own hand, while the panic Morgan was publicly managing continued around him. The documents do not record Morgan's private response to this news. What they do record is that his rescue operation continued without interruption. On the afternoon of Tuesday, the 22nd of October, the same afternoon Knickerbocker suspended operations. The president of the Trust Company of America arrived at Morgan's office and asked for help. That evening, Morgan convened a meeting with George F. Baker, president of the First National Bank of New York, and James Stillman of the National City Bank. Also present was George Cortelyou, the United States Secretary of the Treasury, who confirmed that the government was prepared to deposit federal funds into banks to support their reserves. Morgan's overnight audit of the Trust Company of America showed it to be fundamentally sound. On Wednesday afternoon he declared, and the phrase is documented, "This is the place to stop the trouble then." He released aid to the Trust Company of America. The New York clearinghouse banks followed his lead. The terms on which Morgan extended rescue were not charitable. The interest rates charged to institutions that received emergency liquidity ranged from 10% to 60% on overnight loans. When Morgan invited 14 banks to contribute to the emergency pool of $23 million on October 24th, he negotiated the terms from a position of absolute leverage. The banks that joined the pool did so, knowing that refusing Morgan's request during a crisis he was managing was not a commercially viable option. His network of relationships across Wall Street made his requests during the panic effectively compulsory for any institution that intended to continue operating in New York financial markets after the crisis ended. What happened over the following 2 weeks was unlike anything the American financial system had experienced. Morgan operated from his private library at his Madison Avenue home, directing the flow of capital across the New York banking system from a private residence. He solicited cash from large financial and industrial institutions and had it delivered directly to the loan post at the New York Stock Exchange to support brokers who were willing to extend credit. He was not alone in the public theater of reassurance. John D. Rockefeller, the only private individual in America whose financial resources were comparable to Morgan's, publicly announced during the acute phase of the panic that he would contribute half his personal fortune to stabilize American credit if necessary. He deposited $10 million in New York banks and issued a statement to the press. The two most powerful private fortunes in America were being publicly committed to preventing a collapse that the United States government had no mechanism to address. Rockefeller's announcement helped restore depositor confidence alongside Morgan's operational rescue. But where Rockefeller made a public statement and deposited funds, Morgan made decisions about which institutions deserved rescue and which did not, that Rockefeller's deposits could not influence and the public never voted on. The exchange remained open. Morgan had prevented what would have been one of the most catastrophic single days in American financial history. His rescue operation was real. The capital he deployed was real. The sleepless nights were real. None of that is in dispute. What is also real and documented is what he acquired while conducting it. Morgan's rescue operation continued through the first days of November. On the evening of the 4th of November 1907, he convened the Trust Company presidents at his Madison Avenue library. The New York Times reported the session under the headline, "Bankers confer with Mr. Morgan. Long discussion in his library not ended until 4 o'clock this morning." The Trust Company presidents who attended that session negotiated through the night under Morgan's direction and produced a commitment to a $25 million consortium rescue pool for the Trust Company of America and Lincoln Trust. The terms were Morgan's terms. The timeline was Morgan's timeline. The men in that library room had no alternative authority to appeal to. What Morgan decided in his private library at 4 a.m. became the rescue architecture for the American financial system. When the acute phase of the panic subsided, Morgan did not simply return his capital and step back. He absorbed the Mercantile Trust and 6 more trust companies and banks, including the Trust Company of America and Lincoln Trust, the 2 institutions whose rescue he had publicly championed during the crisis. His Guarantee Trust and Manhattan Trust Companies absorbed them through merger arrangements. The institutions Morgan had saved from collapse during the panic became institutions Morgan controlled after it. He entered October 1907 as the most powerful banker in America. He emerged from November 1907 controlling a significantly larger share of the New York banking landscape than he had held when the crisis began. During the same weeks, Morgan also purchased $30 million of New York City bonds. The city government itself had approached insolvency during the panic, unable to borrow in frozen credit markets to meet its ordinary municipal obligations. Morgan bought the bonds. A private banker purchasing municipal debt to prevent the government of the largest city in America from defaulting on its obligations was an act without precedent. It was also an act that gave Morgan a claim on the creditworthiness of New York City that no elected official had authorized and no public institution had approved. By early November 1907, the acute phase of the panic was subsiding. The trust companies had been stabilized, the stock exchange was functioning, the call money rate had retreated from its extraordinary heights. But one crisis remained. A large brokerage firm called Moore and Schley had accepted the stock of Tennessee Coal Iron and Railroad Company as collateral on a substantial volume of loans. Tennessee Coal and Iron, known as TC&I, was the second largest steel producer in the United States. As TC&I stock fell during the panic, Moore and Schley faced the prospect of a catastrophic margin call that would destroy it and trigger another wave of institutional failures. Morgan examined the situation and identified a solution. United States Steel, the corporation Morgan had created in 1901 by purchasing Andrew Carnegie's steel empire and merging it with other producers, would purchase TC&I stock from Moore and Schley at panic prices. The purchase would rescue Moore and Schley. It would also give U.S. Steel control of its largest domestic competitor. TC&I held estimated mineral reserves of 700 million tons of iron ore and 2 billion tons of coal. It controlled steel and iron facilities across the American South. Its acquisition by U.S. Steel at panic-depressed prices represented one of the most advantageous corporate acquisitions in American industrial history. There was one problem. The merger of U.S. Steel and TC&I came dangerously close to violating the Sherman Antitrust Act. The two companies together would control an extraordinary proportion of American steel production. Without explicit presidential approval, the deal could expose Morgan and U.S. Steel to criminal prosecution. Morgan sent Elbert Gary, chairman of U.S. Steel, and Henry Clay Frick to the White House on the morning of the 4th of November, 1907. They arrived at 8:30 in the morning before President Roosevelt had finished breakfast. They explained the TC&I acquisition to the president and told him they needed his assurance that the government would not prosecute U.S. Steel for the purchase. Roosevelt gave it. He told them, and the exchange is documented in his own presidential correspondence, that he would not feel it was his duty to interpose any objection to the acquisition. He understood, he said, that the acquisition was necessary to prevent a financial panic. The documentation of this exchange is significant for a specific reason. Roosevelt had built his political reputation as a trust buster. His administration had dissolved the Northern Securities Company, one of Morgan's own railroad consolidations, in 1904 following a Supreme Court ruling. Roosevelt had publicly presented himself as the man who would restrain the concentration of corporate power that the Gilded Age had produced. On the morning of the 4th of November 1907, he gave the most powerful private banker in America explicit immunity to acquire his largest steel competitor at panic prices, without a hearing, without a review process, and without any public announcement until after the deal was done. Roosevelt later expressed private regret about the decision. His successor, William Howard Taft, who had promised to continue Roosevelt's trust-busting policies, subsequently attempted to prosecute U.S. Steel for the TC&I acquisition under the Sherman Antitrust Act. The case went through the courts for years. Morgan died in 1913 before its conclusion. U.S. Steel ultimately prevailed. Morgan had rescued the American financial system. He had also, in the course of rescuing it, acquired his largest steel competitor at a fraction of its value with the explicit blessing of the President of the United States. 5 years after the panic, Congress convened an investigation. The Pujo Committee, formerly the House Committee on Banking and Currency Subcommittee on the Concentration of Money and Credit, was chaired by Representative Arsène Pujo of Louisiana and led by counsel Samuel Untermeyer. Its mandate was to investigate whether a small group of Wall Street bankers had accumulated so much control over American finance that they constituted an illegal money trust. The committee met between May 1912 and February 1913. In December 1912, the 76-year-old J.P. Morgan was called to testify under oath. He appeared on the 18th and 19th of December and was questioned by Untermeyer for several hours across 2 days. The testimony is preserved in full in the Congressional Record and is available through the Federal Reserve Archival System for economic research. What Morgan said under oath is extraordinary. He acknowledged that 18 major financial corporations were under the effective control of a consortium led by himself, George Baker, and James Stillman. Just these 3 men personally represented control over $2.1 billion through 7 banks and trust companies: Bankers Trust, Guaranty Trust, Astor Trust, the National Bank of Commerce, Liberty National Bank, Chase National Bank, and Farmers Loan and Trust. The committee found that 341 directorships in 112 corporations worth over $22 billion were held by members of Morgan's banking consortium. When Untermeyer pressed Morgan on the concentration of financial power, he gave an answer that has been quoted ever since. He told the committee that credit was not primarily based on money or property but on character, that a man he did not trust could not get money from him under any circumstances, that a man he did trust could have money without any collateral at all. Untermeyer then asked Morgan directly, "Is not commercial credit based primarily upon money or property?" Morgan's answer was recorded verbatim in the congressional transcript. "No, sir," he said. "The first thing is character. Before money or anything else, money cannot buy it." It was an extraordinary statement, and the committee understood its implications immediately. The most powerful banker in America had just told Congress under oath that the fundamental basis of the American credit system was not law, not regulation, not any public standard of accountability, but his personal assessment of individual character. He was 76 years old, he controlled more capital than the federal government spent in a year, and he was telling the representatives of the American people that he alone decided who deserved access to the credit that the economy required to function. Untermeyer then asked whether Morgan was satisfied that when he and a small group of associates had the money of the country in their control, it was safe. Morgan replied that he did not feel he had it in his control, that no man could get it in his control. Untermeyer replied, "Not if he were the world's greatest banker?" Morgan answered, "No, sir." The committee did not believe him. The Pujo report, 258 pages of careful documentation, found that Morgan and his associates exercised effective veto power over which companies could access public capital markets through 3 deliberate mechanisms: membership restrictions at the clearinghouse that excluded competitors, interlocking directorates that tied institutions together under common leadership, and control of the stock exchange listing process that determined which companies could raise public capital at all. The report concluded that this concentration was not accidental. It had been built deliberately over decades. The report did not directly answer the question of whether Morgan had allowed Knickerbocker to fail while knowing exactly what would follow. The documents do not contain a private memorandum in which Morgan stated his calculations. What they contain is a timeline, a man who was prepared before the crisis, a list of which institutions received rescue and which did not. 6 additional trust companies absorbed into Morgan's network after the rescue. $30 million of New York City bonds purchased when the city could not borrow elsewhere. A competitor acquired at panic prices with presidential immunity. And a congressional investigation 5 years later that confirmed the concentration of power the panic had produced and consolidated. The Knickerbocker Trust's 48,000 depositors did not receive that answer. Charles Barney did not live to hear it. What the congressional record preserves is Morgan's own testimony about how the American financial system actually operated, who controlled credit, how that control was exercised, and what the criteria were for deciding who received it. The answer was not law. It was not regulation. It was not any public institution. It was one man's judgment. 3 years after the panic ended, 6 men boarded a private train at Hoboken, New Jersey, bound for Jekyll Island, Georgia. Among them was Nelson Aldrich, chairman of the Senate Finance Committee, and Paul Warburg, a senior partner at Kuhn Loeb. Their 9 days on Jekyll Island produced the blueprint for the Federal Reserve System, the institution that would permanently replace J.P. Morgan as the lender of last resort in American financial crises. The chain from the panic to Jekyll Island is documented in the congressional record. The Panic of 1907 produced the Aldrich-Vreeland Act of 1908, emergency legislation that created the National Monetary Commission to investigate the American banking system and recommend reforms. Senator Nelson Aldrich chaired the commission. He spent 2 years studying European central banking systems. In November 1910, he convened the Jekyll Island meeting with 6 men sworn to secrecy. The group included Frank Vanderlip of National City Bank, Harry Davison of J.P. Morgan & Company, Benjamin Strong of Bankers Trust, who had been Morgan's investigator during the panic, and Paul Warburg of Kuhn Loeb, who had been advocating for a European-style central bank for years. The men who had been in the room with Morgan during the 1907 rescue operation, who had watched one private citizen decide the fate of the American financial system from a private library, designed a permanent institutional replacement for that arrangement. The Federal Reserve Act was passed in December 1913. J.P. Morgan died in March 1913, 9 months before the institution designed to replace his function came into existence. The Panic of 1907 had demonstrated that the United States needed a central bank. The men who designed it had watched one private citizen decide the fate of the American financial system from a private library. The paper trail of how they replaced that arrangement is in the same archives. The Morgan papers are at the Pierpont Morgan Library in New York. The Pujo Committee testimony is in the congressional record and available through the Federal Reserve Archival System for Economic Research. The presidential correspondence covering Roosevelt's approval of the TC&I acquisition is in the Roosevelt Presidential Papers at the Library of Congress. Ron Chernow's The House of Morgan draws on the Morgan Archive directly. Every claim in this video is in a publicly accessible primary source. If this is the kind of forensic financial history you've been looking for, please subscribe to the channel. And if this video changed how you think about the men who decided which banks live and which banks die, share it with someone who still believes the panic of 1907 was simply a natural disaster that one good man happened to fix. Leave a $sign in the comments if you made it to the end. I will see you in the next one.